Right now, BigBear.ai, ticker BBAI, is trading at $5.80 per share. This is a critical point because the stock is actually down about 2.8% on the day so far. But that price tells you almost nothing about the absolute chaos that has defined this stock's morning. The expectation, if you woke up and saw the headlines, was that this stock was an absolute rocket. It was reported to be surging 23% in pre-market trading, and it did. The stock gapped up massively at the open, hitting a high of $7.13. The reason was a flood of what looked like pure good news. The company reported its third quarter 2025 earnings, and it beat expectations. It posted a narrower-than-expected loss of just 3 cents per share when analysts were braced for a loss of 5 or even 7 cents. Revenue also came in at $33.1 million, beating the street's $31.8 million estimate. On top of that, the company announced a major $250 million acquisition of Ask Sage, a generative AI platform specifically for the defense and national security sector. Following all this, Cantor Fitzgerald raised its price target on the stock to $7. This was the perfect bull case narrative. And yet, here's the reality. The stock is at $5.80. From that $7.13 high, sellers have taken complete control. The stock has faded all morning, giving back almost all of its massive gap up. This is a brutal textbook example of sell the news. The expectation was a breakout. The reality is a massive rejection. A bull trap that has likely left thousands of traders who bought at the open deep in the red. The question we have to answer today is why? Why did what looked like a perfect storm of positive catalysts fail so spectacularly to hold its altitude? The answer is found when you look just one level deeper than the headlines, and it exposes the fundamental battle that is tearing this stock in two directions. The common belief is that BBAI is a pure play on the artificial intelligence boom, a small-cap company poised to capture massive government and defense contracts. And that is partially true. But the reality that the market is trading on today is far more complicated. Let's start with those earnings. Yes, they beat estimates. But the headline number that long-term investors, and more importantly, short sellers, were looking at was the year-over-year revenue. That revenue of $33.1 million, while beating estimates, was a 20% decrease from the $41.5 million they brought in during the same quarter last year. The company itself stated this was primarily due to lower volume on certain U.S. Army programs. This is the core tension. The company beat lowered expectations, but its actual business, its core revenue stream, shrank significantly. The narrative of explosive growth suddenly looks a lot less convincing when your top-line revenue is falling by a fifth. Now let's add in the acquisition of Ask Sage. The bulls see this as a brilliant, forward-thinking move. BigBear.ai is buying a company that plugs directly into its core mission, providing secure generative AI for the government. It strengthens their position, and it adds a new, high-demand product to their portfolio. But the bears, the ones selling the stock from $7 down to $5.80, see something else. They see a company whose organic revenue is shrinking, and it is now spending $250 million to buy growth. This looks less like a strategic addition and more like a necessary patch to cover a hole in their own business. Where did they get that $250 million? Well, the company conveniently raised $337 million in a stock offering not long ago. So they diluted shareholders to raise a pile of cash and are now using that cash to buy a company to make up for their own slowing revenue. This is the kind of financial engineering that makes long-term investors very nervous. This brings us to the most critical and perhaps most misunderstood part of the BBAI story: the short seller activity. This stock is a war zone. According to the most recent data from Fintel, a staggering 17.71% of BigBear.ai's free float is sold short. That is an incredibly high number. It means that for every 5 shares available to trade, roughly one of them is a bet that the price will go down. This is the fuel that retail traders on platforms like Reddit and X see, and it's why BBAI is constantly a topic of short squeeze discussions. The expectation is that with such high short interest, any good news, like this earnings beat, could trigger a massive cascading squeeze as shorts are forced to buy back their shares. But the reality, once again, is more complex and far more telling. When you want to understand if a stock is a real squeeze candidate, you cannot just look at the short interest percentage. You must look at the cost to borrow. This is the fee that short sellers have to pay to borrow the shares they want to sell. If that fee is high, it means shares are scarce and shorts are desperate, and it costs them a lot to maintain their negative bet. This is what creates the pressure cooker for a squeeze. For BBAI, the short borrow fee rate is currently just 0.60%. That is not high. It is in fact extremely low. It is practically free for short sellers to borrow this stock and bet against it. This single data point tells us that despite the high 17.7% short interest, there is no scarcity of shares to borrow. Large institutions are more than happy to lend out their shares to short sellers, collecting a tiny fee. This is not the setup for a high-cost, painful squeeze. It is the setup for a long, drawn-out fundamental argument. So, what's the short thesis? Why are so many large players betting against this company? It's not just a guess. The thesis is based on the very things we see in the earnings report. They are betting that the company's reliance on lumpy, inconsistent government contracts will never allow it to be consistently profitable. They are betting that the 20% year-over-year revenue decline is not an anomaly, but the start of a trend as competition from giants like Palantir and even Microsoft and Google heats up. They see the cash burn, the shareholder dilution from stock offerings, and the $250 million acquisition as signs of a company struggling to build a sustainable business model, not one that is thriving. What's your take on that high 17.7% short interest? Is it smart money betting on the company's unprofitability, or is it a sign of manipulation? For investors looking to navigate this is where you need to be extremely careful. You can find this data yourself. You can look at platforms that aggregate short interest data. But don't just look at the headline number. Look for the borrow fee rate. Look for the days to cover, which for BBAI is just 1.15. Because volume is so high, a short seller isn't trapped. They can get out of their position in about 1 day. Also, look at the failure to deliver or FTD data. In late September, BBAI saw significant FTDs, with over 1.8 million shares failing to be delivered on 1 day. This can be a sign of settlement issues or other market shenanigans, and it's what fuels a lot of the retail-driven theories. But it's not the same as a high-cost borrow squeeze. Right now, the shorts are not in pain. They are in control. They allowed the stock to gap up, drew in all the excited, fear of missing out buyers, and then began methodically selling into that strength, and they are winning the day. This is precisely the kind of pump and dump hell that some users on Reddit forums were warning about just days ago. The sentiment online has been a mix of extreme bullishness and extreme caution, with experienced traders warning newcomers not to get trapped in an earnings pump. Today, we are seeing that warning play out in real time. So, what is BigBear.ai? What does this company actually do that makes it so compelling and so controversial? At its core, BigBear.ai provides AI-powered data analytics and decision support. Their clients are primarily in the U.S. government, particularly the Department of Defense and the intelligence community. They build systems that take in massive, overwhelming amounts of data, from sensors, reports, surveillance, and supposedly make sense of it for commanders and analysts, helping them make faster, better decisions. This is without question a critical and high-growth field. The U.S. government is pouring billions into AI to keep an edge over global rivals. BBAI is in the right place, but the business model is tough. Government contracts are huge, but they are slow to win, they're subject to budget cuts and political whims, and as we saw this quarter, they can shrink. The company has been trying to pivot to push into the commercial field, but that is an even more crowded field where they have to compete with every tech giant on the planet. This brings us to the future outlook. The expectation from the bulls, who are now holding shares they bought at $6.50 or $7, is that this is a temporary setback. They believe the Ask Sage acquisition will be integrated quickly, that it will open up new revenue streams, and that the company's raised guidance of $125 million to $140 million for the full year proves that management is confident. They see today's price drop as a buying opportunity, a shakeout of weak hands. But the reality, however, is that the company is now in a race against time. The acquisition has to work. It has to be integrated flawlessly, and it has to start contributing to the bottom line immediately to justify its $250 million price tag. The core business has to stop shrinking. The company must prove that the 20%